This is a critical moment. The Senate is on the verge of adopting legislation that could cost the American people dearly in the future. The House bill with respect to capital formation, which is labeled a jobs bill but goes more to fundamentally change security laws, is in effect another regulatory race to the bottom. There has not been a normal committee process in terms of weighing this legislation. These are complicated details. The interaction of the securities laws and many different securities laws has not been sorted out, analyzed, and as a result, we are rushing to justice or rushing to conclusion. Hasty deregulation has repeatedly been the source of financial crises. The savings and loan crisis, the Enron era crises, the Great Recession of 2008, and the list goes on. And those who were impacted by these crises, who lost their savings or dealt with cleaning them up, experts in this field and many more have come out in strong opposition to the House proposal. From the chairman of the Securities and Exchange Commission, Mary Shapiro, to the North American Securities Administrators Association, those state officials charged with enforcing securities laws, state regulators, auditors, financial analysts, pension fund managers, the AARP are among those who have spoken out against this flawed legislation and supported my efforts to protect investors. This capital formation bill is fundamentally flawed and should not become law in its present form. It undercuts and dilutes investor protections and has no real requirements to protect American jobs in order to use these new procedures. That's what's so ironic. We have a jobs bill, but absolutely I see nothing in this bill that requires creating American jobs to earn the benefits of this bill. And it is, I think, again, misnomered as a jobs bill. In addition to the substitute amendment I offered with Senators Landrieu and Levin and others that received a majority vote earlier this week, I offered an amendment that we'll be voting on later today to clarify the shareholder trigger for Exchange Act reporting so that all companies count their actual shareholders so they cannot avoid periodic reporting requirements. Adoption of this amendment would achieve one of the stated goals of the legislation, which is ostensibly to have more companies in a transparent market disclosing and or listing on stock exchanges. That was the whole essence of this IPO on-ramp. Encourage more people to go public so they can disclose information to shareholders so that the market can follow them, so that investment advisors can advise about purchasing the stocks on the market. Now, this is one glaring loophole with respect to my proposed amendment, but frankly, too many others remain, and I have grave concerns about the impact this underlying bill will have on the middle class. Theoretically, this bill is supposed to promote the flow of capital to emerging businesses, but in practice, it would likely promote and continue to promote fees paid to investment bankers and others to bring these companies public. There's nothing wrong with that, but there's nothing in this underlying legislation that's going to require discounts because of the reductions in accounting costs. There's nothing in this legislation that will change that dynamic. It could, however, this legislation, give insiders more ways to manipulate the market while average investors are left out in the cold. There is a difference between cutting red tape and allowing insiders to cut corners, undoing the common sense safeguards that protect people who play by the rules. The House bill lowers standards for taking a company public and lowers standards for protecting the public from investment fraud. This so-called IPO on-ramp desperately needs an off-ramp through more careful consideration by the Senate or the House in conference so that we can improve some provisions which have great merit but need improvement. This bill would allow very large companies with up to $1 billion in revenues per year to avoid financial transparency and auditing disclosures designed to ensure that they are not manipulating their books, while enjoying lighter regulation for up to 5 years after the IPO. If this unbalanced bill becomes law without these needed improvements, it could weaken oversight of Wall Street, oversight that in the past has provided investors protections that are extremely important. Again, there is merit to the idea of giving small startup companies more financing options, but the devil's in the details, and the way this bill was written and packaged could actually have the opposite effect and ultimately make it harder to raise capital.